First, let me define emerging markets. These are economies that show signs of development but haven't reached full maturity yet. Here, we focus primarily on Latin America, drawing from our extensive experience in this region. However, the principles we'll discuss can offer insights applicable to other emerging markets like the Middle East, Africa, Southeast Asia, and Eastern Europe. Look, emerging markets come with a fair share of both advantages and challenges. One of the bright sides is that they can often have higher economic growth rates compared to developed markets like the US. However, navigating emerging markets can be tricky due to a variety of factors. Regulatory complexities, political instability, underdeveloped infrastructure, and currency fluctuations are some of the hurdles you might encounter, which are less prevalent in more established economies. Given the additional risk factors pertaining to emerging markets and the time lag of the startup ecosystem versus the US, so-called copycat models have historically been amongst the most successful ones. Think of Mercado Libre, which started as the eBay of Latin America, Careem, which started as the Uber of the Middle East, or Lazada, which started as the Amazon of Southeast Asia. These success stories thrived because they didn't reinvent the wheel. They localized proven business models from the US to fit the needs of their respective regions. They were standing on the shoulders of giants. For investors, this meant mitigating innovation risk as they were backing models with a track record of success elsewhere. VC funds want companies in big markets with high growth rates. That means if you're not kicking off in the primary market of a region, you've got to have international expansion on your radar from day one. Let's say you're launching your business in Colombia. Sooner or later, you likely set your sights on Mexico, simply because Colombia's market alone might not be big enough to scale into a billion-dollar business. Think of Rappi. Likewise, if you're operating in the UAE, you look at Saudi Arabia down the road, given its deep funding opportunities and larger market size. Think Careem. In emerging markets, your talent strategy needs to be regional from day one. Let's say you're launching a startup in Dubai. Since top-tier tech talent is scarce locally, you have to look for it beyond the UAE borders. Maybe in other Arab countries, but likely even outside the Middle East, say India. Similarly, if you're operating in Mexico, it's worth considering setting up tech teams in Colombia or Argentina. They speak Spanish, they have great universities that produce a strong tech talent pool, and you may get more bang for the buck. Venture activity in Latin America has definitely grown thanks to the likes of SoftBank being very active over the past years. And the venture landscape is constantly evolving. Bicycle Capital, some of the ex-SoftBank guys are starting to ramp up the activity in the region. Other established players that have traditionally operated in earlier stages, think Kasek, have launched growth funds. However, access to capital is still limited, and entrepreneurs seeking later stage funding may find themselves needing to look beyond LATAM, probably to the US or even the Middle East. Now, speaking of the Middle East, things are undergoing a dramatic transformation, particularly in the UAE and Saudi Arabia. These nations have huge sovereign wealth funds like Mubadala, Adia, and PIF, which are increasingly dipping their toes into venture investments. This trend is essentially reshaping the investment landscape, reducing the reliance on US or Asian investors for startups in the region. In emerging markets, financial markets are less mature and smaller in scale than the US. This can pose challenges when it comes to acquisitions or IPOs, as these events occur less frequently and may be more difficult to execute. Recently, there's been a shift in the global macro environment, with many US funds pulling back their investments in LATAM. However, this doesn't mean that you can't build a great business and get funding. The US market, with its size and maturity, is undeniably attractive, but it's also incredibly competitive. It's by far the most competitive market to play in. On the other hand, navigating emerging markets demands a more resilient mindset, as things often take longer and can be more complex. But exactly because of this, there's less competition and you have the chance to establish quasi-monopolies and build a strong moat early in the game. Think of what Nubank did, building a multi-billion-dollar business. Emerging markets are not just about the challenges, they're about the untapped potential. For entrepreneurs willing to navigate this complex landscape, the reward can be immense. Here's to creating the next big thing in emerging market. Go get it! That's it for today. Thanks for watching. If you found this valuable, please share it with others that may benefit from it. Make sure to like and subscribe to our channel, and I'll see you soon in LATAM.